While manufacturing has struggled, one part of the US's economy is sending a very different signal. New data shows the service sector ended the year with surprising strength, and markets are paying attention. The U.S. service sector delivered a strong performance in December, according to the latest ISM Services Purchasing Managers Index, offering a positive signal for overall economic momentum. The ISM Services Index rose to 54.4 in December, up from 52 numbers in November. The reading came in well above the 52.2 market consensus and exceeded all forecasts, making it the strongest result since October 2024. A PM reading above 50 indicates expansion, while a reading below 50 signals contraction. December's result clearly places the services sector firmly in growth territory. The services PM is based on surveys of purchasing managers across industries such as healthcare, finance, retail, transportation, and professional services. Participants are asked about activity levels, new orders, employment, and business conditions, making the index a key indicator of economic momentum. Several components of the report showed notable improvement. Business activity rose to 56.0, up from 54.5 in November, suggesting firms saw stronger demand and higher output levels toward the end of the year. This reflects increased activity across a wide range of service-based industries. The employment component also showed a meaningful turnaround. It climbed to 52,048, marking the first expansion reading since May. This suggests service sector firms are beginning to add workers again after several months of caution. Perhaps the most encouraging signal came from new orders. New orders jumped sharply to 50.79 from 52.9, indicating a strong pipeline of future demand. Rising new orders are often viewed as a leading indicator, pointing to sustained activity in the months ahead. Economists say the strength in services highlights an ongoing imbalance within the U.S. economy. While manufacturing has faced pressure from higher borrowing costs, inventory adjustments, and softer global demand, the service sector has remained more resilient. Consumer spending on services, along with business demand for professional and financial services, continues to provide support. Inflation dynamics also remain in focus. Services inflation has been one of the stickier components of overall price pressures. Strong demand and improving employment conditions suggest the Federal Reserve will continue to monitor the sector closely when assessing future interest rate decisions. From a market perspective, the data reinforces expectations of steady economic growth, rather than a sharp slowdown. Equity markets often respond positively to signs of service sector strength, while bond markets tend to interpret strong PMI readings as reducing the urgency for aggressive interest rate cuts. Looking ahead, analysts will be watching to see whether the momentum continues into early 2026. Key areas to monitor include whether employment growth remains consistent, whether new orders stay elevated, and how pricing trends evolve as demand strengthens. Overall, December's ISM Services report paints a picture of an economy supported by a robust service sector even as other areas remain under pressure. As the new year begins, this strength provides a stabilizing force for the broader U.S. economy and an important signal for policymakers, investors, and businesses alike.